Good morning, everybody. Happy Thursday. It's nearly the weekend. Have you been as busy as I've been this week? I bet you have been, with economic activity in the UAE snapping back into overdrive. Indeed, the world's economic response to COVID-19 has led to a V-shaped recovery in global equity markets. But the question remains, what comes next? Particularly as we close out the final quarter of 2021 and look ahead to 2022. I'm Scott Armstrong. I'm the editor-in-chief of Arabian Business, but you don't need me to unpack this for you, particularly as we've got a panel of experts waiting in the wings, far smarter than I. Not hard, I hear you cry. In this, the Global Investment Outlook Q4 2021 with Emirates Islamic. First up, let me open the floor to Wasim Saifi, the Deputy CEO Consumer Banking and Wealth Management at Emirates Islamic. Wasim, over to you.
Warahmatullahi wabarakatuh. Bismillah ar-Rahman ar-Rahim. Welcome to all our guests on this webinar on Global Investment Outlook Quarter 4 2021. Certainly very interesting time and additionally certainly very interesting time since we last spoke to you when the situation that we were in was a little different. The last few months have seen a very, very interesting move in terms of the way the global markets, the regional markets, the UAE market has developed, and not just from an investment perspective, but the investment perspective will get covered more by our team of experts who will be addressing you. But just in terms of the general business sentiment, we've seen a significant improvement across most of the parameters over the last few months. Now, this is a big vote of support and vote of thanks really to the UAE government for the excellent handling of the pandemic, and alhamdulillah seeing the whole economy bounce back very well, people confidence, mood bouncing back. You don't have to go far, just looking at the traffic on the road, looking at the presence of people in malls, the airports slowly picking up, visitors coming in, is a very strong indicator of the comeback of Dubai and comeback of UAE, and to a large extent also comeback of the world from the difficult times of COVID-19. Certainly vaccination and the way the authorities have handled that has helped a lot, but also the various support that has been provided by the different governments of each of the Emirates, by the central bank, by the banks in trying to support the business community has helped in the whole recovery process. We as a bank, if we look at our own performance in 2021 and the first half year numbers were an indication of that. We've seen a very strong comeback. We see a strong comeback also in terms of volume growth. We are seeing a strong comeback in terms of card spends, all of which giving an indication that the customer sentiments have changed. People are spending more money, people are investing more money, and this is excuse me, this has certainly helped the economy move forward. From our side, and there have been various forms of support that we have provided to our customers in the form of deferrals of some of their installment payments, giving people some break, at the early stages for profit, for particularly the retail customers who are affected either by job losses or affected by leave without salary. So in any form that some of that still continues, though I must say that most businesses have now got back to their feet and have gone back to normalcy in many sense. Many of the retail customers who were affected by job losses, some have seen their jobs disappear, but many others have seen a comeback. They've been, if they were on leave without pay, have been called back to work. If there have been salary reductions, some of that have seen that coming back. So all in all, it looks like a good position be in. Certainly, if we look at ourselves and compare it with the rest of the world, UAE is standing today a lot stronger than many of our counterparts in other parts of the world. Lastly, with Expo 2020 and the great initiative that it has been for the country, we've just seen that the early response seems to be very strong. From whatever I hear, booking numbers seem to be growing quite well. So we're all looking forward to 6 months of the Expo tempo also being there in the local market and making an impact to visitors from around the world who will come to visit us. I won't take any more of your time, because the important part is the presentation that Maurice and his team are going to make. So please enjoy the webinar. Please, with whatever you need from us, we are always there for you. Syed Umair and his team are there to support you in every form. And whatever else we can do for you, it will be our pleasure. Thank you so much for all your support, as always. Over to you, Scott. Thank you so much.
Thank you, Wasim. And I tell you what, you're not wrong about the traffic on the roads, are you? So next up, it's the man with whom a conversation is like drinking 5 strong cups of coffee in one go. Of course, it is Maurice Gravier, the Chief Investment Officer at Emirates NBD Group. But before we turn to Maurice, we want to get you, the audience, involved in a poll by answering this question. With regards to the global economy and the COVID-19 virus, do you think that A, times are more positive and there are more positives and negatives in the coming times ahead? B, that times are gloomy and there are more negatives than positives ahead? Or C, I've got my vaccine and that's what I think about right now? Please answer our poll, submit your answer. But now it's over to Maurice, who will paint the big picture for us. Maurice, the floor is yours.
Thank you, Scott. Salam alaikum. Good morning to all. My team and I are absolutely delighted to welcome you to this quarterly update. We are 9 months into 2021. We'll make, as Scott just said, I will present the big picture, then we'll make a deep dive into equity, fixed income, and even a bit share with you what we think about crypto assets and why we don't include them in our investment framework yet. So without further ado, let me see the results of the poll. You are optimistic. Good news. We are also optimistic. So let me start, as always, in full transparency by what we said last year for the year and what actually happened. What we said for 2021, I had 3 messages. We expected positive but moderate returns. We expected volatility to strike, and it has happened in the last 3 months, I must say. And we said that all stars were aligned for emerging markets. That was our outlook for 2021. What happened so far? Well, no doubt it's a good year for developed market assets and the risk ones in particular. Should it be real estate, the REITs are up 15%, or stocks in developed markets. However, it's a differentiating year and it's a difficult one for defensive assets. Gold is down 7%, interest rates are rising, so safe bonds and sukuks are also down in terms of total return. So what was right, what was wrong? Moderate but positive return. Yeah, we are here, +1, +2, +4% for our 3 profiles. I'll come back to that. It was right to be overweight stocks and underweight bonds, but it was not that right to believe in emerging markets, which are so far an underperformer. So what did we change? In June last year, in June this year, a few months ago, we started to reduce risk because we were expecting a volatile summer. And now we have started very gradually and selectively to come back to increase exposure again, because we are constructive for the end of the year. So why is it so? Let me now turn and look forward. I will take you through the 3 pillars of all our investment decisions, which are the backdrop, what happens. We believe that the recovery is not broken. It has lost momentum. There is some inflation, but it remains very strong. Second element, the valuations. Interest rates are too low, and that's an issue for Sukuk in particular. Equity valuations are expensive in developed markets, but there are reasons to be so, and we'll come back to that, and we think they should remain expensive. They are cheap in emerging markets, but the issue there is that we don't know when it will normalize. We're confident for the long term, but we don't know where it will normalize. The 95% that I've shown here means that US stocks have only been more expensive in history 5% of the time. We are really a bit stretched. Finally, the third part of our investment framework is about behavioral factor, which is positioning an investor, their sentiment. And there is good news, is that people were absolutely unanimously bullish and optimistic 3-4 months ago. This is the Bank of America bull and bear indicator. It has started to normalize and we are more in neutral territory. So let's start with the backdrop. And the backdrop, the economy, it's first about the virus. And the chart that you can see here is the number of cases per million inhabitants in a selection of large countries. You can see the 4 waves of the virus, and no doubt the Delta variant is a very tough one. When you look at the number of infections, it's more or less the largest one. Currently, every day in the world, 600,000 people contract the virus. It was 350 in June, so it's worrying. And when you look at the green curve, if you can see it, it raises question because it is Israel, the most vaccinated country in the world, together with the UAE, and you can see that the numbers have risen. So when you look at that, you say, wow, that's a bit scary. Our take is, first, cases are rising because economies are reopening. Mobility creates the rise in infection. It's not the Delta variant by itself. It's just that when people are in lockdown, nothing happened. And second, and the most important, is that what matters for the economy, it's not the number of cases, it's the severity and the pressure on healthcare systems. And if we look at that on the following slide, this is the number of COVID-19 patients in hospitals in a selection of countries, because we don't have this data for all the countries, but still you can see that the 4th wave, 1, 2, 3, 4, looks very different than from the previous one. It happens that we have learned to live with the virus because vaccinations, they may not be that effective in preventing you from contracting the virus, but they are effective in reducing the severity. We live with it. I will take an example, another example, Switzerland, which is more or less the same population as the UAE. Country-wise, in all Switzerland, there are 400 patients in hospital. 400 for the entire Switzerland. It looks manageable. So we don't think that the virus will threaten growth, and I wanted to start with that. That's an important thing. We said that growth was good because the vaccine was under control, and the second pillar of our thesis was the fact that there is magic money. What we call magic money, it's the fact that central banks around the world have printing trillions of money. We're talking trillions. As you can see on the left side, these are the total assets of major central banks. The increase is amazing compared to what has been spent now. 2008, 2009 was like a picnic. So central banks on the left, they print money, and governments on the right, they have spent money to avoid, I would say, permanent destruction in the economy, to make sure that people would still have income and would be able to find their job after. The point is that this magic money, great thing, it worked. The economy is growing by maybe 6% this year globally. Now, this magic money should fade. And yes, it should, because first, this level of extraordinary response is not justified anymore by the current situation. And second, as you can see on the top left, inflation is back. And no later than yesterday evening, we have had the US Consumer Price Index for September, which showed a 5.4% year-on-year increase. It means that prices for the consumer are now 5% more expensive than they were 1 year ago. 5%, it's not nothing. So is it a threat to the economy? First, let me share with you our stance on inflation. Inflation is not that much the result of central bank printing money. It's the result of economies reopening. It unleashes this pent-up demand. People are here, they want to go out, they want to spend. And in France, you have supply which is constrained because of the COVID, because of the fact that we don't have people to produce things, to move things. There is a shortage of truck drivers a bit everywhere. Supply chains are saturated. So as a result, price increase. We believe that that's the reason inflation is a byproduct of growth. It's not the scenario of stagflation. It's something we don't believe in, because if growth were to slow materially, and I'll come back to that, inflation would slow because demand would slow. So we think that it's a byproduct. Inflation is temporary, but this temporary is longer than we could thought because it takes time to fix a supply chain. It takes time to restart a chip factory, and we are there with some inflation. Now, back to magic money. First, will it be reduced? Yes. Why? Because the economy is good. If the virus if the virus were to come back and to harm the economy again, no doubt central banks would support again. The withdrawal of the support is conditioned to better economic circumstances, and it's good to keep it in mind. Second, will it shock the markets? Probably not. Yesterday, we also had the minutes of the Fed meeting. They said explicitly, yes, we will start tapering from November, and interest rates went a bit lower because it has been perfectly communicated. And finally, but very importantly, is it the end of magic money? We are not sure, because if you look at the bottom left chart, public debt is an issue, and most of the major economies are well above 100% of their GDP in public debt. We have seen a sharp increase. You remember the amount that had been spent. What does it mean? It means that governments can simply not afford to have materially higher interest rates. If you run a 100% debt to GDP ratio, like France, 120 almost, if you pay 3% on your debt, you have 4% deficit without having done anything else, and that's not something that they should do. We believe that monetary and fiscal policy will work together forever in a way, and there was a quote from Ronald Reagan who said, "Nothing lasts longer than a temporary government program," and we believe that it may happen. So the virus, we think it's fine. Magic money, it will fade, but it shouldn't shock the economy. So what does it make for growth? These are the latest forecasts from the IMF. When I say the latest, the teams at Emirates Islamic have been able to change the slide in the last minute, because yesterday it was an update from the IMF. It's interesting to see an update from the IMF in October, because usually this very reputable house, they do 2 global economic outlook per year. This year, they felt like, oh, we have to do a third one. They came with a message saying the economy has lost momentum and uncertainty has worsened. So that's scary. How did they change their number? Their expected growth for the global economy this year was downgraded from 6% to 5.9%. It means they have changed nothing. The global economy is very strong, and we believe that it will remain so. Again, we have inflation because of these supply chain bottlenecks. We also have an energy crisis, and on oil, we know that demand is rising and supply is rising gradually, but it will adjust because it can adjust. In natural gas and this kind of thing, it's not just about demand, it's also about infrastructure. It may take time, but it will, and we believe that we have a time of high growth and significant inflation. But the good news is that demand is linked to reopening, and suppliers, they also reopen. So they will adjust their supply, and we think that gradually, in a way, these supply chain bottlenecks, they create potential for future growth. So on the backdrop, we are positive. Now let me speak about valuation, and I think I should speak faster. No, it's probably not possible because I'm already late. Before talking about equity valuation, let me tell you a word about interest rates. And there is a mystery. If you look at the left-hand chart, the gray line is inflation. It's the US core PCE. It's the Fed's preferred measure of inflation. As you can see, it is higher than at any point in time in the last 20 years. Inflation is back. The purple line is the 10-year government bond yield interest rate, 10-year interest rate. And as you can see, it is certainly not at its highest point in the last 20 years. It is closer to its lowest. What does it mean? It means that if you invest in a sukuk, let's say which total return reflects the US 10-year yield, and if inflation was to stay where it is, it means that your expected return for the long term is negative. That's what we call real rates. You take the return you get minus the inflation, and that's the right-hand chart. It is absolutely super crazily expensive. So either inflation has to come down or interest rates have to come up. These levels are just amazing. It has consequences on precisely the equity valuations. That's what you have on the left-hand chart is the current equity multiples of developed markets in orange, They are high. They are super high. They haven't been higher since the 2000 bubble. So that's a bit of a worry. And in gray, it's the emerging market multiples. Okay, they are not at record high, but they are not cheap as well. They are only cheap compared to developed markets. So is it scary? Well, again, it is linked to the level of interest rates. And what you can see on the right-hand chart are the dividend yield for equities in developed markets in orange and in emerging markets in gray. You see they are very stable, around 2 to 3%. And you can compare them to these real interest rates over 10 years, which is the inflation-adjusted return that you can get from a 10-year sukuk, let's say, which is currently negative. So when you see that, you feel that, yeah, equities are not that expensive. And that's why we definitely prefer equities over sukuk in our allocation, because you have some cash, you have some positive cash. Some people will say, hey, you remove inflation from the interest rate, which is true, but you don't remove it from dividend yields because it's a simple dividend yield. Yes, but inflation is part of the dividend, because when you are a company, if you have price increases, your sales are up and your profits are up. There can be impact on the margins, but it is a nominal asset. So that's a key difference, and also why we like equities. Behavioral factors, sentiment and positioning. And interestingly, it's two different things. Well, first, it's been a crazy year. We have seen, the SPAC, blank check companies raising billions. It's just somebody coming and say, hey, give me your money, I will make an acquisition, it will be great. And people buy this. We have seen these meme stocks, GameStop or these kind of things, where people were gathering on internet forums to attack the short positions of hedge funds, and they were up like 100, 200, 500, 700%. Crypto assets, the value of Bitcoin, which is the bottom right chart, it has exceeded the value of Pfizer, Visa, Facebook. How many years did it take to build a company like Pfizer, who is selling to the world the best vaccine, and it's worth maybe 1/3 of what Bitcoin is worth without any underlying. So when you see all these, you feel like, okay, it's a bit hot. Something could go wrong. IPO market is very hot. And the bottom left one is how much of the US average household wealth does equity represent? It's the highest ever. So what do we say about that? Positioning is heavy because there is no alternative. Sentiment has normalized because people were super bullish just 6 months ago. Now they are a bit more scary, but still with this positioning, it means that we have a risk of volatility. Again, we think that this positioning is justified, but with sentiment, there is some vulnerability. So what are our key messages? I'm already late. First, our central scenario is that we should generate an additional 2 to 4% return on our profile for the end of the year. Volatility is here to stay, and we have to be prepared for that. We are long-term investors. Volatility is not adverse. You just have to be not to be excessively leveraged, and you just have to be ready to stomach the volatility, because otherwise it is an opportunity to adjust your exposure. When there is a crash in a fundamentally constructive picture, which may happen, it's an opportunity to buy. Third message from me, and my colleagues will tell you about equity and fixed income. We have borrowed returns from the past. As I told you, interest rates, they may be too low, but they won't go super high anymore because of these levels of debt. Growth in the post-pandemic world will be more in emerging markets than in developed markets, which will face the same problem as before. Valuations are expensive, so the long-term returns that we can expect are lower than what we had before. And frankly, 3% is the new 5%. Now, why volatility? I told you, vulnerable sentiment, elevated what? Positioning, vulnerable sentiment, elevated valuations, and risk that can worry the market. We are not that worried. COVID forever, another COVID wave, we think it's manageable. Policy support, it will fade. We think that markets won't be shocked. Inflation, it will last, but at the end, it will recede. Geopolitics are always something you don't know. Speculation bubbles could create a shock. Yes, we have all these risks, but we believe that the big picture remains constructive. Still, we will have volatility, which means opportunity to buy and sell. Volatility means that we are not overconfident in our own views. I know it sounds weird, but if you had asked us at the beginning of the year, what was our level of confidence in our central scenario, I would have told you 80, 90%. Now it's 60%. I would say 60% probability that we generate this 2 to 4%. 30% probability, there is a problem because the market is scared by something. It could be the Chinese financial situation with the Evergrande. It could be a crash in crypto assets. It could be a fifth wave of the virus. In this case, our return will be negative, but they will be better than competition because we are a bit more defensive overall. 10% probability, like last year, the fourth quarter is booming. We don't think it will happen, but never say never. In this case, we would return double digit on our profiles, but be probably below our competition. Our positioning, I'm sure you won't be very surprised, we are reasonably constructive. Constructive means that we prefer stocks over sukuks. There is no ambiguity. We are overweight in stocks and underweight in the fixed income. Within stocks, we are more overweight on developed markets and slightly on emerging markets. More or less, we have 3% overweight on stocks, 2 on developed markets, 1 on emerging markets. Why is it so? Emerging markets, they are our long-term preference, but tactically, short-term, there are many risks and volatility. Developed markets, it's the opposite. We think that the short-term is favorable because of the Q3 earnings season, which has started, which is very good, which will reduce the valuation multiple, by the denominator. It's not that if price doesn't change, but you see better earnings, well, the multiple gets better. And we think that the impulse is there tactically. Ideally, at some point, we will move our overweight from developed market to emerging market. And that's the key thing. For the rest, we are mostly neutral. We are neutral on cash because, again, we expect volatility, which means that we have to be ready to seize opportunities. It can make a difference. And talking about differences, our philosophy. Our goal is to outperform our competitors in difficult times and be like them, more or less, when things are very good. This is the case for our 3 profiles: cautious, moderate, aggressive. What you can see here, we are always super transparent, is our performance in gray compared to our international competitors in orange. So in 2018, we did better in difficult times, no issue. In 2019, we were close to them, slightly below, I must say, because it was a booming year. Last year, we were very happy to do both because during the first part of the V-shaped that Scott was mentioning, we were defensive. We sold stocks in February. We bought back in March, so it was the perfect year. We outperformed our competition by maybe 4 or 5% on every profile. This year, we are below. So far, our returns are 0.8%, 2%, and 4.4%. It is below the competition. Why? Because first, our allocations are built to preserve capital, not losing money on 3 years, 5 years, 7 years. It means that we have more defensive assets than our competitors. And remember, defensive assets this year, it's a bit tough. Second thing, we have more emerging markets than them because we believe that long-term, the story is here. We just have to see the UAE. And by the way, the UAE is a key overweight for Anita, and it worked fabulously well. It's one of the best performing regions within emerging markets. There's not only China, but still this year having more emerging markets has been a bit detrimental. That's it for me. I'll see you in the Q&A. I've been a bit too long. Up to you, Scott.
Thank you, Maurice. And if you're interested, that's about 0.0000001% of Maurice's brain that we've just downloaded there. It's good to see from the poll results that most of you are actually positive about the times ahead. Only just under 10% of you are negative. It's Thursday. Cheer up. And we're here in this fabulous, interesting webinar. And so that's the poll result. Before we go on to the next presenter, we're going to crowdsource some more wisdom from you with a second poll. And what we'd like to know from you this time is if you're looking at, you just heard Maurice talking about how they're feeling about emerging markets. What's your favorite region for the next few years? Are you A, emerging markets? They give you low valuations and high growth economies. B, developed markets, the tech leaders of the past decade. Or C, you'll take a bit of both. You like a balance. So please submit your questions. And this is a perfect time to remind you as well about questions, that if you've got a burning question for any of our panel, we've got the live Q&A at the end of the presentations. So submit your questions via Q&A. Next up, it is the irrepressible Anita Gupta, the head of equity strategy for Emirates NBD, who will take us through a quick look at the equity markets. Anita, it's over to you.
Good morning, everybody. And just carrying on from what Maurice said about us being, positive equities and why we are. I'm just going to go to a little bit of detail. So, post the pandemic induced crash in March last year, global equities have returned 90%. Favorable monetary policy, record fiscal stimulus, and of course, very strong corporate earnings are the catalyst behind these extraordinary gains. However, the backdrop has changed. We have moved from digital COVID winners to cyclical recovery trades and now on to quality. So what do we see, going forward? We see the shift between growth and value continuing. The dark blue line in front of you is the MSCI World Growth Index. The orange line is the value. So till November last year, growth led, and then value took over as investors began worrying about rising sovereign yields, which would lead to, a lower present value for growth sectors such as technology. Looking at the regional performance, developed markets are leading year to date. The US and Europe have had an almost uninterrupted trajectory of gains since March last year. GCC and India overall lead global returns year to date. However, emerging markets have lagged because of the high weight of China. Looking at sectors, we've got energy in the lead, high oil prices driven by mobility numbers ticking up in demand, followed by financials, of course, benefiting from higher yields. So we look at the market health checklist to see what would affect equity performance not only in 2021 but 2022. EPS or earnings growth is definitely the biggest factor influencing equity performance, has the highest correlation. We have seen that in 2020, earnings globally fell by 15%. In 2021, estimates are for emerging market earnings to be up 30% and developed markets around 50%. Q3 earnings season has begun for the US. Expectations are for a 27% growth. So far, we have seen JP Morgan, BlackRock come out quite positive numbers. Consumer demand is on the pickup. Record equity inflows about 775 billion so far. So looking at what we are neutral, we think yields are in a sweet spot right now. Valuations definitely developed market is to worry about. What worries us then? Inflation, energy costs, labor costs, supply chain issues around increasing freight costs. It's about a 300% increase for shipping from China to the US, a chip shortage. And now going into our positioning. We are overweight equities. We have a higher overweight in developed markets, of course, driven by the quicker vaccination drive and the reopening. We, in the tactical side, favor the US, still home to the world's most innovative healthcare and technology companies. On the emerging market front, we think that the large middle class digital revolution will eventually bring back the growth premium. We like EMEA out here, and we are neutral emerging market Asia. Alpha can be added to portfolios through sectors and themes, while we are agnostic as to the shift between value and growth at this point. For cyclicals, we would invest in financials. For growth, technology. On a defensive front, healthcare. And quality pays. If you look at the lighter blue line, the gray line on the chart in front of you, that is our long-term growth portfolio, and that has outperformed the MSCI World Developed Market Index by over 30%. Our CIO office fair value estimates for equity indices for the end of 2021 predicated higher returns from developed markets, and that's exactly what has happened. However, we are below our fair values for emerging market and China, though we had expected lower returns. We are not even close to our fair values right now and probably would end the year below the fair values. India, we have overshot. The Indian stock market has done extremely well, driven by demand and inflows. And GCC, where we predicated the highest returns, that has definitely been met, and we do expect that this could overshoot. So where do we go from here? On China, we are neutral. We don't think it's time to be bottom fishing. The mandate of common prosperity, social equity is there to stay. If you look at the chart in front of you, it is the domestic China stocks that are outperforming the Shanghai Composite Index. What is underperforming and has lost 40 to 50% are China stocks listed in the US, the Golden Dragon Index, the China Education ETF, if you look at it, they've all fallen 30 to 40%. So how do you position in China? Stay with the asset allocation. Domestic shares are least impacted, and also ESG strategies we think would continue to benefit with the government's focus on reducing carbon emissions. And our favorite, the UAE market. Now, we have been overweight the UAE since October last year. And if you look at, the reforms that have been brought in, whether it's the new visa policy, whether it is, the increase in foreign ownership limits by companies, it is the increase in IPO issuance. You've got Yasat Satellite, you've got Fertiglobe, ADNOC Drilling, all adding to the breadth of the market. So where we stand today, the Dubai index is up about 18% year to date. You've got the Abu Dhabi index up 60%. So very definitely much to look forward to on the UAE market. Oil is supportive. The sectors we like are banking, dividend yields have been maintained, real estate, the oversupply is regulated, and much of end user from expats is coming in out here. Themes. There are three long-term trends we think which are going to influence equity markets. If you look at the chart, most of the themes that we are considering have been outperforming global equities. Global equities world returns are the fourth from the bottom. The orange line is last year's returns, and the gray line is year to date. Whether it is AI, cloud, millennials, digital, everything has been outperforming global returns. So the three long-term trends we are looking at is technology and connectivity, healthcare synergy with technology, and of course, overlaying everything is environmental, social, and governance factors looked at not only by individuals, but corporates and governments. Technology sector. So after 500% returns over the past decade, do you think there is any more upside left? Yes. Definitely, we have a number of regulatory issues, whether it is privacy around data. We see Facebook being questioned by the US Senate. It is monopolistic concerns around e-commerce and Amazon's hold on the market. So would we still invest in the FANGs? Yes, because they have a very strong EPS CAGR over 20 to 25% for the next 5 years. Also leaders in what they do, especially in cloud and in data. However, there are certain themes we say are what would drive the technology sector going forward. Within this, we look at 5G and electric vehicles. Connectivity is more and more important, though, of course, beset by cybersecurity concerns, because the better connected, the more access there is to criminals. Healthcare and the synergy with technology. Now, this has been highlighted with the pandemic, increasing use of telemedicine, digital therapeutics, and research spent today is not just governed by the large pharma companies, but it's by genomic companies, the messenger RNA technology, which brought a vaccine to the market in 10 months compared to 10 years typically. CRISPR technology, which can modify your DNA to treat therapies. And again, many new therapies coming out through genomics. And of course, the global physical activity economy now worth $1 trillion as everybody worries about their personal health. Last of all, of course, is the overlay of environmental, social, and governance factors over everything. Climate change, the increasing importance given to carbon emission reduction by economies, the transition to a circular economy by companies. And our favorite or our top theme in terms of ESG is electric vehicles. If you look at the chart in front of you, the increasing penetration of battery electric vehicles, whether it is the US, Europe, or China, that's very clear. It has been absolutely astounding. The increasing focus of governments on what they are willing to do to boost electric vehicle production. And of course, we're seeing 150% increase in electric vehicle sales in 2021 compared to 20. And it's not just the manufacturers that you could invest in, there's lithium battery charging stations. So to conclude, we stay positive on equities. We see further the muted performance into the rest of 2021 and 2022. Expect volatility, but expect the strong corporate earnings to be supportive. So back to you, Scott.
Thank you, Anita. Much to think about there. And also thank you to the audience. Many of you responding to our poll. And it seems we have some quite wise heads out there. Nearly, 70% of you like the mix, like a balance between emerging markets and developed markets. A further 23% of you are actually a bit more adventurous and you're all in on emerging markets. And only 8% of you feel safe and looking back to the developed markets, those tech leaders of the past. So interesting. Right. While we're getting all these good feedbacks, we're going to go on to the next question of the poll, which is another interesting one. The 10 years US government yield. It's currently around 1.6%. Now, for you, I'm interested to know, is that A, relatively low, given the levels of debt? B, reasonable, it is safe, and at least it's not negative? Or C, attractive, central banks will keep on buying and it may go to zero? Please give us your thought. We're really enjoying seeing you respond to the polls. And I'll take this opportunity again to remind you, you've got these fantastic experts just at the touch of a button. So please submit your questions for the live Q&A in the Q&A box. But now we'll turn to the Super Satya Singh, the head of fixed income strategy for Emirates NBD. And Satya, it's your fixed income update. Over to you.
Thank you, Scott. Welcome everyone to the fixed income part of the presentation. We'll tackle the answers to the poll questions and our views in the midst of the presentation. But before that, how we started 2021. Our advice was to get comfortable with risk. That meant we are underweight safe haven assets such as investment grade debt and developed market government treasuries. But that also meant we are bullish and overweight on high yield and emerging market debt because we anticipated yields would increase and the higher spread headroom of this riskier asset class would protect your portfolios against the impact of that. We also emphasized on the importance of Fed communication to avoid a 2013-like taper tantrum. But then volatility happened. You can see how 10-year treasury yield moved quite differently in each of the 3 quarters on the left-hand side of the chart. And on the right-hand side of the chart, you can see that actually mirror on the segment returns. Q1 and Q2 segment returns of the fixed income segments were completely mirror opposite each other. And in Q3, we have seen mild positive returns except Asia high yield, which is facing idiosyncratic issues. So our predictions that high yield would provide you the best value came true. Emerging market debt were right in the middle, and developed market government treasuries and IG debt were right at the bottom. So where do we go from here? Our advice again is to get reasonable with risk. And here we reveal our views on the 10-year treasury. We think the 10-year treasury yield should end the year at 1.75%, and currently it's trading around 1.5%. So it will increase, but not by a lot. We are still underweight on developed market treasuries and investment grade debt, especially investment grade debt has a long duration and is pretty expensive. We have turned neutral on global high yield, and the only overweight we have is on emerging market debt. About GCC debt, we're again neutral because we think a lot of capital appreciation has been taken out of the picture, and further returns will typically be driven by carry. Starting our deep dive with high yield, I think there is a tussle between improving fundamentals versus expensive valuations. You can see on the left-hand side how the YTD defaults have actually plateaued. This is majorly a result of a lot of primary issuance that have been happening. So companies are flush with cash. And what we have seen is that the credit metrics across high-yield issuers have improved. Let it be total debt to EBITDA, let it be your interest coverage ratios or gearing ratios. So that means the default rates will remain benign. But what worries us are the expensive valuations. The spreads for the global high yield is below 100 bips. And we think again that from here onwards, you will not see the superb returns that we had realized YTD, and returns will be more muted going forward. That's why we are neutral. Our overweight on emerging market debt is driven purely by technicals. If you look at the left side chart, the red triangle actually represents the current spreads and the circle represents the historical median spreads. And if you compare against other asset classes, emerging market provides you the best relative value. And that's why we are overweight on that. The only angst is that emerging market sovereign has a long duration. So be very careful and only go into this asset class when yields go up by 10 bips or 15 bips and take a pause. Go into this asset class. China onshore IG is another asset class we think most of the investors miss in their portfolio, but it provides you very good diversification opportunity. And you cannot afford to miss it because it's the second largest asset class after US Treasuries at $16 trillion. Moreover, default rates are always benign and it has low correlation with other emerging market assets, as you can see from the right side chart. See the way it behaved in 2018 and 2020. Focus on the orange line, that is China IG. While other riskier asset class spreads actually blew out, the spreads actually tightened in China IG, which will always protect your portfolio. And it's always good to have some allocation to such a defensive assets when, as Maurice and Anita have pointed out, we expect volatility in the near future. Now, coming closer to home, MENA debt, as we mentioned, a lot of capital appreciation is out of the picture, and total returns from here onwards would be driven by carry, maybe except Egypt. If you compare high yield versus investment grade, then high yield MENA entities, sovereigns, they have actually outperformed their investment grade counterparts. And it has been mostly due to the spread compression that you can see on the right side in Oman sovereign curve. And across the maturities, it has happened. In contrast, Bahrain and Egypt have actually widened. Between Egypt and Bahrain, we continue to prefer Egypt, especially in the 7 to 10 year part of the curve, because that's where we have seen the most widening happening. But going forward, we think Egypt has enough FX reserves. Its current account deficit is under control and should improve with tourism opening up. And that's our bet. Within Oman, we still like the 7 to 10 year part of the curve. That's where you get 4.5% plus kind of yield. And also various quasi-sovereign entities from Oman are our preference, such as Omantel, Omgrid, Lama Funding, Oman Oil. These are all our preferred choices within the corporate sector. Remember, S&P has actually revised Oman's outlook to positive, and it could result, if Oman continues on its fiscal consolidation, it could result in an upgrade within 12 months. Now, coming to the interesting asset class, Sukuk, we think the performance has been very, very resilient under increasing regulatory constraints. But we believe these regulatory constraints would actually standardize the sector and in the long term will be beneficial for the segment. We have seen that YTD Sukuk issuance have actually bounced back after a slowdown, and we think it will end the year at one of the best years in the last decade or so. But focusing on the total return distribution, what worries me is that most of the returns for YTD has been driven by risk-on scenarios. So you can see that on the right side chart, you can see 30 plus years of perpetuals from weaker banks have given you a lot of returns. Similarly, high yields have given you a lot of returns. But with volatility coming ahead, we would advise you to avoid weaker bank perpetuals, which typically have a call date either next year or the year after that. They might not be called in the current scenario, and some of them will reset their coupons slower than you had anticipated. So it would not be good for the overall returns for the asset class. And more importantly, we have seen some distress cases, some restructuring such as Garuda, such as Sarba Dynamic, which have affected a lot of investors. So be very careful in your positioning. We like the sovereigns from the region and as well as quasi-sovereigns, as I mentioned, Lama Funding, Noga Holding. They still prefer give you juicier yield, and there you should be positioned. One more question we'd like to tackle is that when 10-year treasury yields increase from the current levels, how will this asset class behave? There is good news for Sukuk investors because we believe 50% of the outstanding Sukuks would mature before 2026. That means they have less than 5 years of duration. And only 1% of the total Sukuks outstanding have a maturity of more than 2030. So the overall weighted average duration of this asset class, it's somewhere around 5 years. So even if the yields increases a lot, the impact on this asset class is not going to be that much. So don't worry about the impact of yields, worry on the credit aspect of the sukuks, and that's why we advise you to go into higher quality. That's all from my side. See you in the Q&A section. Over to you, Scott. Thank you.
And as Satya said, yes, of course, he will be there live in the Q&A at the end of the presentation section. So please, again, submit your answers. And to talk about that poll question just before Satya spoke, well, not many of you think that 1.6% on the 10-year US government yield is attractive, just 5% of you. With the rest of you rather mixed, with 41% saying it's reasonable, it's safe, and a 54% of you saying it's relatively low given the levels of debt. So next, we turn to my favorite subject, which is cryptocurrency, purely so I can remind Maurice about his coffee story, which, unlike my jokes, never gets old. But before we do, a question for you all out there in cyberspace. The final poll question: how would you scale your understanding of crypto assets? Which is A, a believer and well-versed and invested in crypto. B, intrigued, I've heard about it. Is it really so easy to make money in that space? Or C, indifferent. It can be a good name for my new cat. So please give us your answers. We'd like to hear from you. And finally, it's on to Emirates NBD's head of asset allocation and quantitative strategies, which is as difficult to say as it is to spell, the redoubtable Giorgio Borelli and his mature look at crypto assets. So, Giorgio, over to you.
Thank you, Scott. Good morning, everybody. I'm pretty and welcome to this new world of cryptocurrencies, of course. I'm pretty confident that most of you are well aware of the high speculative appeal of cryptocurrencies and also of the exceedingly high volatility of this new asset class. But I'm equally confident that not many of you do know about the social utility of cryptocurrencies, which really drives their demand. So today for you, I'm going to look into both sides of the digital coin, so to speak, both into the social utility side and into the volatility side. And the conclusion is that the volatility of cryptocurrencies is still too high for their broad adoption across our society, and from cryptocurrencies to find a large space in the portfolios of institutional investors. And this is also why we are refraining from advising on the asset class still. So what are cryptocurrencies? Well, they are basically a means of exchange and a store of value. So they're in a way, they are very much like money. And in another way, they are not like real money. Simply because they don't exist in the real world, but they are they exist in the form of encrypted transactions which are carried out on a specific network, which is called the blockchain. The main feature, the innovation brought about by the blockchain, is that it can ensure validation and execution of a transaction without the need for a third party and typically a bank. Of late, there has been a lot of interest on the institutional side in cryptocurrencies, maybe not so much because of their speculative appeal, but much more because of their social utility. So what is all of this social utility about? Well, the key word in this sense is transaction. Remember that the blockchain and the related digital coin, the Bitcoin, were born as a payment system. And the payment system derives its value from the number of transactions which are carried out on that system itself. So the value of cryptocurrencies increases with the number of transactions, and it's related to that. But since the number of transactions in turn is related to the business cycle, higher transactions at the top of the business cycle, lower transactions at the bottom of the business cycle, it also stands to reason that returns of cryptocurrencies must be related to some measure of the global business cycle. Well, and this is exactly what is the message that is conveyed by this slide. The gray line is the 12-month return of Bitcoin, And the orange line is an indirect measure of the global business cycle. You can really see that the price of Bitcoin to quite a good degree tracks this measure of the global business cycle. So we come to a first important conclusion that cryptocurrencies are a cyclical macro asset. And as such, they can hedge from a portfolio point of view moderate amounts of volatility, much in the same way as equities do. But if you're looking to hedge massive amount of inflation, like skyrocketing inflation, then you'll have to fall back on a non-cyclical asset like gold. Bear in mind this difference. This is pretty important. So what about the possibility of telling more money managers, including cryptocurrencies, crypto assets in general, in their portfolios? We think that we are not there yet because of the extremely high volatility of the asset class in general, hence the limited visibility that institutional investors have about future returns. Given that low visibility, there is no reasonable expectation of a positive return, hence institutional investors will be holding back until volatility subsides. And this is exactly the message which is conveyed by this slide. Focus please on the left-hand side. Orange line, this is the proportion of 12-month Bitcoin returns explained by some common market factors. As you can see, there is no consistency. The line jumps up and down. Many times it's close to zero. It means that the risk that Bitcoin in this case brings up to the table, brings to the portfolio, is very specific and cannot be explained by other asset classes. Yes, if we have a cryptocurrency specific risk, cryptocurrencies diversify portfolios. But again, if volatility is too high, institutional investors don't care yet. So it's too soon for a broad adoption of cryptocurrencies in the world of finance for the inclusion in institutional portfolios in a large share. Now, coming to the next topic, is it possible to tell whether cryptocurrency is overvalued or undervalued? Yes, it is possible. Let me introduce you the net worth to value ratio. In a way, it's similar to a price to earnings ratio. It's a ratio of two variables, one market variable, one non-market variable. So it's a ratio of the market cap of Bitcoin and the dollar value of the transactions executed on the blockchain. As you can see, the gray line, when the gray line is closer to the upper end of the range, you'll be looking to sell Bitcoin in this case, and when the gray line, the NTV ratio is closer to the lower end of the range, then you would be looking to buy Bitcoin. This is mostly indicative. It's not a very precise relationship, but still indicative. Now, what, on the other hand, if we want to put a fair value, a number to Bitcoin, in this case, again, for simplicity, for explanatory purposes? Yes, we can, but the notion of fair value for cryptocurrencies, again, is devoid of significance because of their exceedingly high volatility. So let me introduce to you the notion of gold risk equivalency. Some investors claim that one day Bitcoin will replace gold, and hence the market cap of Bitcoin will be at least as large as today's gold market cap. So to get to the fair value of Bitcoin, according to this thought process, we should multiply today's Bitcoin price, this is as of the 30th of September, by the ratio of gold to Bitcoin market cap. This is only halfway correct because capital allocation consumes risk. Hence, we should also divide by the ratio of the volatilities. And if we do this, we get a fair value at the end of the calculations, which is below 30,000, while currently Bitcoin is above 50,000. You may well understand how this notion of fair value is made. It is not very significant due to the high volatility of the asset class of the cryptocurrency. And now, Well, we have seen a lot covering cryptocurrencies. What about a lot of positives? What about the negatives? There is a lot of challenges for this asset class. Let's think about central bank digital currencies. One day, most likely, they will exist. They will be rolled out, and when that happens, the scope for the existing cryptocurrencies will be, of course, much smaller. What the exact implications for this are unknown as of yet. There is also a regulatory push which is going to drive bouts of volatility across the asset class. You remember that China banned cryptocurrencies. The United States don't want to ban cryptocurrencies, but for sure the White House wants to regulate them. So in this respect, because of regulatory interventions, you should be ready to brace yourself for volatility in the cryptocurrency space. This is all on my side. Thank you for the presentation. Thank you for attending. I hope you enjoyed the presentation and that you learned you got insights about the social utility of cryptocurrencies.
Thank you, Giorgio. Fascinating stuff. I mean, it obviously seems it's a conversation that isn't going to go away. And if we look at the responses to our poll, only 15% of you are indifferent to cryptocurrency, with indeed nearly 20%, 19%, you're a believer and you're well-versed. And another 65% of you are intrigued. So I think this is a conversation that is going to keep returning, and we will keep reporting on it. So that's it from the presentations. As we bring this segment to a close, I would like to invite Saeed Omer, the head of private banking and wealth management at Emirates Islamic, just to wrap up what we've learned. Saeed, over to you.
Assalamu alaikum. Good afternoon. Assalamu alaikum. Good afternoon, everyone. First of all, I'd like to thank everyone, all of our clients who had joined this webinar and giving us time to be able to share our insights from the CIO office and what is our outlook for investments from the year ahead perspective and how we have done so far this year. I think it has been a very interesting year during the course of 2021, especially as the volatility on the equity markets and the various other asset classes came into play. And as such, we decided, normally we do these type of sessions once a year to give an outlook for the year ahead. But because it's been an interesting year where things have been changing quite a lot, we decided that we should be doing such sessions more frequently, and especially in these type of times, to be able to continuously be giving our outlook and where we see the world's heading, and as such, the investment allocations that should be amended during the course of the year. So this is really from the objective of us being close to our clients and really sharing our insights with our clients on an ongoing basis. So I really hope that this has been useful for the audience here, and I really hope that we found something interesting to be able to share with you. The one last part I would add is, during the course of 2021, we had invested a lot of time and effort in enhancing our wealth management offering to be able to really capture some of the opportunities which have been discussed here. So there's been significant investment, and a lot of you would have seen some of this flowing through to you in terms of our offering. Things like we're able to now offer full equity trading on all the global markets for Sharia compliant assets, including the US markets and the European markets, with extended trading hours to ensure that you are able to capture the full trading hours of the US market and the European markets. We've spent a significant amount of time on onboarding new products to cover different asset classes and geographies. ESG has become, or environmental social governance has become, a very important theme for investing globally for investors, and it's a theme which cannot be missed out amongst the Islamic world. So we had worked heavily with certain partners to be able to introduce products to be able to cover these type of investment strategies. And this is just a summary of some of the efforts we've made, and we expect these efforts to continue with some significant announcements we're expected to make as a wealth management offering by early part of next year, which would really, in essence, show that we are aspiring to become a distinctive Islamic wealth management player, to be able to offer really global investment solutions and vehicles in a Sharia compliant manner to our clients. So I think that's been our focus, and and that's going to be the focus for the coming period. So I'd like to thank all the members and all the audience who had joined this webinar, and good afternoon to all of you. Back over to you, Scott.
Thank you, Saeed. And again, my thanks to all the panelists for their excellent and expert presentations. And thank you for the audience for taking part in all of the poll questions. Right, so this is the exciting bit. We are live. Buckle up, and we've got some good questions coming in. Maurice, as ever, you're up first, my friend. And a challenging question for you. You like emerging markets for long, but there's always a problem each year. When will they outperform? Maurice?
My God, what a great question. You're right. There is a problem every year in emerging market, and that's why when we look at comparative valuation, we should consider that there should always be a discount. Well, always, as long as emerging markets are emerging, because our key point is that there are less and less emerging markets. China is the world's second largest economy, and yes, governance from companies, Saeed Umir was mentioning very rightly the ESG concerns. Governance is not at the same level, and you can have, how to say that, you can have brutal changes in regulations that are not expected. Having said that, even China, the model of China, which is a bit surprising for a communist country, but it looks like it's the US. What they want to be is a global superpower. Should it be in terms of internal consumption, military power, research and development, and you can't do that without capitalism. And I think that many of these countries will convert. You have probably two kind of emerging markets, and some are emerging just because they are at an earlier stage in terms of GDP per capita, but they are catching up. There's nothing emerging in the UAE. It's the most modern economy that you can have. So yes, there should be a discount. There is always a problem. I agree, but looking forward, given the current valuation of developed market assets, given the weight in the economy of emerging regions, it's not marginal. It's around 1/3 of the global economy comes from so-called emerging regions, and it's more than half of the growth because they have, secular drivers of growth. Given that having less than 5% of global institutional portfolios invested in emerging markets is not enough. So yes, every year there is a problem. This year we were wrong. I was wrong personally. I was such a believer in the outperformance of emerging market this year. It hasn't worked. It will work for the long term, and we do long-term investment.
That's a comprehensive answer. Thank you, Maurice. And another question's come in, and this one I'm going to throw at you, Anita. Maurice there talking about China quite a lot, and an interesting question here, kind of like whatever happens in China affects the rest of the world. That old when China sneezes, the world catches a cold, which we won't talk about 2020 and coronavirus about. But they're talking about the Evergrande default, which is an emerging and a really interesting story that's happening in China, and they're asking, how will that impact the world economy, and could that be the next Lehman Brothers? Interesting one now.
Yeah, so thanks for the question, Scott. Now, when we look at China and its role in global investments, so China equities are just about 4 to 5% of the MSCI World Index. So as far as investors are positioned, it's a low positioning. And even those who are overweight, it's not a very large overweight that people have to China. So our stance is stay invested in China, stay with the asset allocation. Looking at Evergrande, and we know the stock is suspended now for the last, more than now 10 days. And yes, that is what worries us, is the governance around. So companies can default. It's not uncommon. It's not, it's never going to happen. There are companies that are going to always repay their debt. There could be issues. So what the world wants is transparency and governance. And this is exactly what Maurice said, that when we look at emerging economies, there is a difference between the different economies. And what we do need is the transparency. Is this going to impact the real estate sector? I think Satya spoke about that, the impact of defaults. Is it going to impact the stock market? Yes, we will see a difference between the sectors within China, the different listings. As I said, US, China companies listed in the US, those are facing more problems. China companies listed in Hong Kong around data privacy concerns. The real estate sector itself, let's wait and watch and see, where that takes us in terms of, defaults.
I can see
Can I
Maurice
add a
wanting
word
to
on
come
that?
back in here. Come in you come, Maurice.
I promise I'll be short. There is one big difference there are many differences between Lehman and Evergrande, but one is that Lehman was like a storm happening in a blue sky. It surprised everyone. Evergrande's situation is known for years. This company has $300 billion of debt and maybe 20 billion of cash in front of that. So people who are investing in Evergrande, they were just speculating that the Chinese authorities will bail them out and that they would make money. It's not what we do. I mean, that's something. People who are stuck with Evergrande bonds, they knew what they were doing, and that's a big difference. And for the systemic aspect, I don't think, because there are million people involved, people who have paid to buy their house and who are waiting for it to be delivered and this kind of thing, and they cannot be left alone. Will China favor international speculators? Certainly not, and I think that they are right to avoid that. Is it a systemic event? I don't think so. Banks are ring-fenced, and the authorities and everyone is well aware of the situation. That's what I wanted to say.
Thank you, Maurice. Right, another good question coming in, and I said that cryptocurrency conversation would keep going. This one is for you, Giorgio, and it's a really interesting one. As more and more countries are accepting Bitcoin as legal tender, and we won't ask Maurice about how he spent his Bitcoin, do you think that countries will start building up Bitcoin reserves rather than the gold reserves, which they do now? I suspect I know your answer.
Well, as I mentioned, there is a big difference between cryptocurrencies and gold.
Yeah.
And gold is a true safe asset, meaning is non-cyclical. So it has a different function. The countries as of now adopting cryptocurrencies are relatively small and relatively, let's say, not that relevant from a macroeconomic point of view. Yeah. So it's difficult to see major countries changing their reserve policies just because other minor countries are adopting cryptocurrencies. The issue is that the expectation is that at least some major countries will start rolling out cryptocurrencies. As I mentioned in the presentation, should limit quite to some extent the scope of the existing cryptocurrencies.
Excellent. I can see that time is almost out on us. Maurice, anything you'd like to say in that space before we close proceedings?
Or maybe about cryptocurrencies, but I love to speak about everything. I wish we could have 4 hours.
I know.
Don't get us wrong. Yeah.
Maurice, Anita, Satya, Giorgio, Said, Wasim, thank you very much for sharing your time. And I'm sorry we can't get through all the questions, but I know the team at Emirates Islamic are pleased to hear from you and ready to answer any questions you have. That's it from me, Scott Armstrong at Arabian Business. I've been delighted to be part of the Global Investment Outlook Q4 2021 broadcast. And thank you to everybody that has participated in today's webinar, and have a great weekend ahead.
Thank you.
Thank you, Scott.
Thank you.
Thank you.